Everyone expects long-term rates to fall the Fed down. Then sometimes they don't. So this piece has the term premium. Here's the mechanism why long rates don't always fall. Here's a puzzle that trips up a lot of smart people. The Federal Reserve starts cutting its rate, and everyone assumes the long-term rate, the one that sets mortgages and the cost of long borrowing, will obediently fall right along with it. And then, sometimes, it just doesn't. The Fed cuts, and the 10-year yield sits there, or even climbs. So what gives? Is the bond market broken? Is it ignoring the Fed? No. There's a missing piece in the picture that most headlines skip right past. And once you see it, those stubborn long rates suddenly make sense. The popular story says the Fed sets long rates. The real story says long rates equal expected short rates plus something extra. A term premium. So let's break a long yield into its real parts. Picture a 10-year government bond. Its yield is built from two stacked pieces. The first piece is expectations. Roughly the average short-term rate the market thinks will prevail over the next 10 years. If you believe the Fed will hold rates around 3.5% on average, that's your base. But nobody locks money up for a decade for free. The second piece is the term premium. Extra compensation you demand for the risk of holding long through 10 years of uncertainty about inflation, about supply, about everything. Put illustratively, a 4% 10-year yield might be about 3.5% of expectations plus a half-point term premium. That premium is the part that can swell or shrink on its own, independent of what the Fed is actually doing. Why does that matter so much? Because it's the piece everyone forgets. Now, the interesting question: what actually pushes that premium up or down? Three forces do most of the work. First, uncertainty. When inflation looks unpredictable, investors demand more to lock money up for a decade, so the premium tends to rise. Think of the early 1980s, when inflation fear ran hot and the premium sat high. Second, supply. When a government runs big deficits and floods the market with new bonds, all that paper has to find buyers, and more supply tends to lift the premium. Third, demand. Who's buying? Through the 2010s, foreign central banks and the Fed itself bought enormous quantities of long bonds, and that steady demand tends to compress the premium, holding long rates down. Back in 2013, a sudden shift in expectations sent long yields jumping, a real era reminder of how fast this piece can move. Picture the premium drifting from something like 0 up toward 1% over time. Illustrative, just to show the direction. Less buying, more supply, more uncertainty. Here's why this isn't just bond desk trivia. The Fed controls the short end directly. It sets the policy rate. But the long end is where the term premium lives, and the Fed does not control that piece. Around 2020, heavy bond buying pinned the premium near 0. Years later, as that buying faded, the long end behaved very differently. So you can get a split. The Fed cutting its short rate on one path, while the long rate goes the other way, because a rising premium is pushing it up. Imagine policy easing from, say, 4.5% toward 3.5%, while the 10-year drifts higher on premium. Illustrative paths, not a forecast. When that happens, the cost of long borrowing, mortgages, corporate debt, anything priced off the long end can stay high or even tighten, even as the central bank is supposedly loosening. The Fed pushes one way, the premium pushes the other. That divergence is the whole reason long rates can defy the headlines. Before you go quoting a number, hold all of this loosely, because the term premium has one slippery feature. You cannot observe it directly. There is no ticker for it, no print on a screen. It has to be estimated by models that try to separate expectations from premium, and different models give different answers. Sometimes a premium near 0, sometimes a full point or more. So treat any specific level you hear as illustrative, not gospel. What's far more reliable is the direction. Is the premium broadly rising or broadly falling, and why? Is supply growing? Is demand fading? Is uncertainty climbing? Those trends are what carry the signal. The exact decimal is model noise, so the framework is real and useful, but the precise figure is an estimate. Watch the trend, not the digit, and you'll read long rates a lot more honestly. So here's the takeaway. Go back to where we started. The Fed cuts, and yet the long rate refuses to fall. Now you have the chain to read it with. A long yield equals expected short rates plus a term premium. That premium can rise on supply, on deficits, on uncertainty, or fall when steady buyers show up. And because the Fed controls only the short end, the long rate can diverge from policy entirely. Hold it loosely. The premium can't be seen directly, models disagree, and the level is an estimate. So watch the direction. None of this is a forecast, and none of it is advice. It's a lens for reading a confusing headline. So the next time the Fed moves, and the long rate does the opposite, you'll know exactly where to look. Don't just watch the Fed. Watch the premium instead.